Hello, I'm Peter Herbert from Insight Training. Welcome to today's short CPD webinar. It's financial reporting, and we're focusing on accounting for provisions for liabilities. Here's the running order. We're going to start off with a recap on the key principles of accounting for provisions for liabilities within section 21 of FRS 102. We're going to look at some topical examples. We're going to think about some important disclosure notes and finish off with some top tips for external auditors. Let's start off with those key principles. Here's the definition of what a provision for a liability is in section 21 of FRS 102. So a liability of uncertain timing or amount. And yeah, the way I've always thought about it is there are three important criteria you have to comply with in order to be able to recognize a provision for a liability in the first place. There needs to be a pre-year-end obligating event. There needs to be a probable future transfer of economic benefits off the back of that obligating event. And the amount to be paid needs to be measurable or quantifiable. I think the two things I want to emphasize here would be that of those three criteria, I've always felt that measurability probably is the least problematical. So any which way will do, really, within reason, to measure the quantum in order to make a provision. And do also remember that you can't provide for liabilities because it seems a prudent thing to do. You've got to make sure that you do meet the criteria. And if you don't meet the criteria, as we'll see with some of the examples that will follow, then you're quite simply not allowed to make a provision. Okay, let's look at these topical examples. And let's start off, if we could, with redundancy provisions, clearly a very topical issue in the current climate. Now, this is dealt with by section 28 of FRS 102 rather than section 21, but the principles are very much the same. So redundancy provisions, employee benefits provided in exchange for the termination of employment as a result of a decision to terminate employment before the normal retirement date, or an employee's decision to accept voluntary redundancy in exchange for those benefits. So that's what we mean by a redundancy provision. Linking back into the previous slide, the key thing here is you're going to have a demonstrable commitment in order to be able to make a provision. That's that pre-year-end obligating event I talked about a few minutes ago, and there will need to be a detailed plan publicly announced and no realistic possibility of the entity withdrawing. And that would need to be in place by the year end in order for that redundancy provision to be recorded. Here's an example, and it links very closely to one in a very useful help sheet produced by the ICAW Technical Advisory Service. I put some information at the bottom of the screen there about where you can access that help sheet if you are an ICAW member. Entity A has 31/12/20 year end, plans to make 20 members of staff redundant. It's been discussing a plan which involves offering 10,000 to each employee who accepts the offer before 31st of March. If we get fewer than 20 signing up before then we will actually make people compulsorily redundant, and they would be paid 8,000 each. And the two questions here are, do we as entity A provide for the costs concerned in the year-end accounts, and if so, how much? Now, I guess the key thing in terms of whether we make the provision in the first place is, do we have that demonstrable commitment? And it may well be that the board has been discussing a plan behind closed doors. It may be it's made a decision about the implementation of that plan, but it's got to create an expectation in the minds of those affected pre-year end. So if that discussion is not culminated in a public announcement, then the obligation does not exist as of the year end, and provision cannot be made. Even if by the point that the accounts are signed off, the payments are made, you can't recognise the provision in the year end accounts unless the trigger event for the recognition is in place. Now, the help sheet deals in a very practical way with the actual quantification of the amounts concerned, and makes the point that what you would do here is, if we assume that the obligation does exist, use the post-balance sheet period to firm up on the amount. So look at who actually does, with the benefit of hindsight, sign up by 31st of March, provide in respect of those employees at the £10,000 level, and then any further employees made compulsorily redundant, obviously as the explanation says there, provide for those at the lower £8,000 rate. Okay, let's move on and look at a different scenario involving repayment of grants. So start off with entity B. Retailer benefited from government grants during 2020 but has prospered and now chosen to repay those monies. What are the accounting implications? One I think that's quite topical in the context of some of the larger retailers that have actually chosen to repay government support received during 2020. Again, as with the previous scenario there, the key thing would be that in order to actually recognise the obligation to make the repayment here, what the retailer would need to do, it would need to demonstrate commitment to make the repayments. That's sometimes referred to in FRS 182 as constructive obligation. So again, a published statement of the intent to repay and a valid expectation therefore created in order for that particular provision to be made. If we do provide, what I would suggest you would do here is take the cost to the P&L in the period in which the obligation came into play, based on what I've mentioned a second ago. And I would say where that particular cost would go in the P&L would be as a negative entry in government grant income. In other words, what you probably would do there, I think, is say, where did that government grant go in the first place at the point we recognise it as income? Put effectively a debit entry against that line in the P&L at the point the obligation is created to make the repayment. So put the actual government grant repayment back in the place where it was credited in the first instance when it was received. Entity C applied for and received grant funding during 2020, which it transpires it was not eligible for. What are the accounting implications? And I think this is a similar scenario. And as with scenario B, if at the year end there's an obligation to repay the funding, in this case because it wasn't entitled to it in the first place, then you would recognise that obligation in the balance sheet and the same way that you would if you were entity B. I think the big difference with entity C is that if it transpires it was never eligible for the grant funding in the first place, then it should not have recognised the grant funding in the first place, and there was therefore a material error potentially in the previous year's accounts when that grant income was recognised. So I think in that situation what you do is treat the reversal, as it were here, as a prior year adjustment and adjust opening reserves to the extent the amount is material and the entity was never entitled to the money in the first place. So similar or same balance sheet outcome here, but different approach depending on whether entity B was entitled but quite simply decided down the line to make the repayment, or entity C where it was never entitled in the first place, and yet if that's the case and if material, there would therefore be need for that prior period adjustment. The final one, which we've been getting a few questions about recently, links into the Supreme Court ruling on 15th of January in favour of small retailers and other organisations which had claimed for business interruption insurance cover from their insurance companies, had been knocked back in the first instance, and the Supreme Court ruling was actually they shouldn't have been knocked back, they should have received payments, and therefore what they originally thought they were going to receive, they are now. And it's really thinking there about the implications, I suppose, of that particular Supreme Court ruling. I think with this one, we're looking obviously at a situation where the entity will be receiving money rather than paying money, in contrast to scenarios A, B, and C. And I think I would argue in this situation here that the Supreme Court ruling as of 15th of January would be an adjusting post-balance sheet event. So use that particular ruling to adjust the year-end balance sheet position in respect of the amount receivable, if relevant. Remember that this is really more to do with the recognition or not of contingent assets. And what FRS 21 talks about in terms of recognition of contingent assets is you can't recognize a contingent asset unless its crystallization is virtually certain. Now, from what I read, I understand that actually, although this Supreme Court ruling has gone in the favor of many small businesses, there may still well be some further discussion and debate going forward whereby that, call it, ruling will be to some extent appealed. So I think we always say with these sorts of situations, when the cash is in the physical possession of the company, that might be a good point to recognise that particular sort of income. Until that point, you've got to be very mindful of that particular criterion. So yeah, definitely some potential to recognise a debtor here, but the key question, I suppose, from an accounting and an audit point of view is the crystallisation of that claim virtually certain? If it's probable but not virtually certain, it will be disclosed as a contingent asset rather than recognition in the financial statements. Okay, let's think about some important disclosures in respect of provisions. Remember that you'll need accounting policy notes where relevant. That could be dealing with provisions generally. That could be dealing with redundancy provisions specifically, as dealt with by Section 28 of 102. And again, it may well be that in terms of the accounting policy notes that an entity includes year on year on year, these issues might not ordinarily be dealt with. But if they're now cropping up for the first time now, that requires a really careful consideration as to whether accounting policy notes would now be needed. Remember that if you're thinking about these areas constituting areas of judgment, or where the quantification of the amount involves estimation uncertainty, then from an FRS 102 point of view, we do have to disclose key judgments and sources of estimation uncertainty over and above the basic accounting policy notes. That again, I'm sure could be relevant. Provision movements by type. So if there were different sorts of provision that we were recognizing, we need a tabular note analyzing movements on the different categories of provision individually. And 102 is very clear about the need for brought forward balance, additional provisions made, provisions used, provisions reversed, and the carry forward. And I think certainly from the accounts I see very often, those particular categories of movement within the provision during the course of the year can very easily, very often get netted off. If the individual movements are there, additional provisions made, provisions utilised, provisions reversed, they do need separately analysing out within that provisions table. And contingent assets, and as we mentioned latterly there, contingent liabilities, they would again need to be disclosed, including specifically the financial effect of a contingent asset or liability, any uncertainties regarding the actual amount, and in terms of contingent liabilities, any sort of agreement in place which may give rise to that particular obligation in some way, shape, or form being reimbursed. So that's kind of a range of considerations there in relation to disclosure notes. A couple of those you'll see that I've asterisked, and the asterisk ones are requirements specifically for small entities applying FRS 102 Section 1A. No specific detailed disclosure of any of that for micro entities applying FRS 105. And the FRS 105 accounts are automatically deemed to give a true and fair view, although over disclosure is allowed. It's not particularly encouraged, but certainly from an FRS 102 point of view, there are certainly a couple of aspects there would absolutely be relevant to small entities as well. Okay, let's wrap up with a few considerations for audit. Now, lots to think about, I guess, in the context of audit. We could probably fill an entire session looking at the audit implications of some of this sort of stuff, but a quick run through, I suppose, some of the key considerations. So do think about the risks in relation to provisions for liabilities when doing audit planning. Do think about the propensity for bias. I think I've certainly on courses throughout last year talked a lot about what I called the risk of kitchen sink accounting, where what an entity might want to do, perhaps to get all the bad news out of the way in this year's accounts, to then improve into next year, or maybe to get a lower profit to get a better outcome for tax, is if anything to over provide. And going back to the point I made right at the start of this short session, remember that you can't provide because it seems a prudent thing to do. You can only provide where the obligations there and the FRS 102 criteria are met. Obviously, from an audit point of view, it will be important to validate the provisions that are recognised and looking to get appropriate, sufficient audit evidence in relation to that validation. I think in the current climate where perhaps audits are being done remotely, validatory evidence is sometimes Not as easy as it might be to find in normal times, but that would still be an important consideration. Don't forget the subsequent event review. I mentioned that in passing, I suppose, a few minutes ago, in talking about the fact that if you think the trigger event is there at the year end to recognise the provision, use the post-balance sheet period right up until the date of signing to quantify the amounts concerned, or get comfort about, from an audit point of view, the amounts concerned. So very important linking, I think, here to subsequent events. May be appropriate to get a management representation in respect of provisions or contingent liabilities which are deemed to be judgmental. Don't forget to audit the disclosure notes. I think the way the auditing standards have evolved, certainly since about 2016, there's lots more focus on disclosure notes than there probably was 5 or 6 years ago. So very important to make sure that from an audit point of view, you're comfortable there as well. And don't forget that for periods commencing on or after December the 15th, 2019, ISA UK 540 on accounting estimates really gets ramped up. So more to do than ever in these areas on audits for effectively 31 December 20 year ends that you'll obviously be doing in the mid to late part of 2021. Okay, so wrapping up then, in terms of concluding remarks on today's short session, the recognition criteria in FRS 102 section 281 are tough, and you can't provide because it seems like a good idea or it's prudent to do so. You've got to make sure that you do meet those relevant criteria. We talked through a couple of the topical issues. Redundancy provisions, restructuring provisions, grant repayment provisions are certainly very, very topical. We talked about the fact that if you're going to recognise money coming in effectively in the situation where you perhaps see a situation where you're perhaps gaining rather than losing, recognition of that particular contingent asset would require virtual certainty of crystallization. We talked about that in the context of the Supreme Court ruling in the session here. Disclosures are challenging from an accounting and audit point of view. Accounting estimate audits thereof is a very hot topic for audit regulators, and will be more so in the later part of this year when revisions come in to ISA UK 540. Okay, hope you found that useful. If you've got any queries or follow-up questions on today's session, do drop us a note at inquiries@insight-training.biz. And for details of our full spring and summer 2021 training program, check out our website at www.insight-training.biz. I do hope you found that useful and look forward to speaking to you all again soon. Thank you and goodbye.